Hi, everybody. Welcome. We're going to get started in maybe 30 more seconds. Okay, I'm going to get things started. Thanks again, everybody, for joining us today. My name is Julia Durante Martinez, and I'm a Senior Program Officer with LISC's National Community Research and Impact Team. We are the research and development shop within LISC, supporting our network of 34 local offices, our national rural footprints, and our national programs with research and local program and policy design. Community ownership and community land trusts have been a focus for us for the last 5 years. And I'm so happy to be co-hosting this webinar with our LISC San Antonio office, focused on lending opportunities to community land trusts. Just by way of brief opening, we know CLTs are gaining ground as an important strategy to develop and preserve permanently affordable homes and create pathways to homeownership. And this growth is very much reflected across all of LISC's network. LISC has invested over $42 million in community land trusts, and 2/3 of our 34 offices are supporting CLTs. And this ranges from capacity building grants and technical assistance to project financing for preservation and for new construction, which includes both rental and homeownership, spearheading planning and peer learning, and helping strengthen coalition infrastructure. We've also developed over a dozen research reports, case studies, blogs, and op-eds to help build the field, and happy to drop some of those links in the chat. So through our work in Houston and San Antonio, of course, Texas has seen quite a bit of CLT momentum recently. New community land trust taking root from San Antonio to Fort Worth, established CLTs in Austin and Houston, expanding their work. And this work really represents an opportunity for lenders. And as there have been exciting strides made in project financing from local government and mission-driven lenders, which we'll hear more about, we know mortgage financing is also top of mind for CLTs with homeownership projects. So we're really looking forward to today's conversation with Nadia Mavrakis, Alex Cabral, Sarah Whitley, and Bill Kopka. We're going to start with some local grounding in San Antonio and some of the exciting CLT progress in the last 4 years. And then we'll turn it to Alex to give us an overview of shared equity models and some of the common questions that lenders have about project and mortgage loans. And then Sarah and Bill are going to take us through a deeper dive into CLT mortgage lending and why lenders should want to do more of these kinds of loans. So it's a lot of ground to cover, but we do have 90 minutes, and we have our Q&A open and time to take questions at the end after our presentations. And we will be sharing the slides and the recording out afterward. So with that, I'm going to turn it over to LISC San Antonio Executive Director Leela Powell to share more about their local work and to introduce our first speaker, Nadia.
Thank you, Julia, and I apologize in advance. They are apparently demolishing the foundation of the building that in which our offices are located. So if you hear a little noise or if I disappear, that's probably the cause of that. But it's super exciting to be here today with this group of very distinguished panelists and to be hearing from Nadia. And I know that her co-CEO, Nader, is also joining us as a participant or listening in on the panel. We are really new to CLTs in San Antonio. We are so new to CLTs in San Antonio that the city of San Antonio has just begun to recognize CLTs in accordance with state legislation that was recently passed. And we are, the state only recognizes residential CLTs at this point, does not have a provision for commercial land trusts. And that has played a little bit into some of the decision-making processes that the members of our CLT cohort have taken as they've looked at how to use this really important tool to meet community needs. So just as this is a new tool for us here locally, Cotorengua, Nadia is a co-CEO, as I mentioned, who's going to be speaking today, is a relatively new CDC. And it's very exciting to see that an organization that is really less than 10 years old has reached the point of maturity and has this incredible grounding in the community that they represent so that they can move forward with planning for something that will be innovative for our region. So I'll go ahead, I think, without further ado, and turn the program over to Nadia. And but I'll be monitoring, as Julia mentioned. Go ahead and put questions in the Q&A. If you put something in the chat, I will try to pick that up and we'll circle back to it after the presentations. Thank you all very much. Nadia?
Thanks so much, Leela. As Leela mentioned, my name is Nadia Mavrakis. I'm co-executive director of Culturingua. My background's in finance. I used to work in the for-profit consulting industry and as Leela mentioned, moved into community development little less than 10 years ago to co-found and co-lead Culturingua, which is a community and economic development organization that's focused on San Antonio's Silk Road Cultural Heritage District, which is a region of Northwest San Antonio that was recognized by the city of San Antonio about a year and a half ago. We have under our umbrella the Silk Road Community Land Trust, and we are a founding member of the Silk Road District Coalition. So on the next slide, I'll talk briefly about the Silk Road District Coalition's approach and how we came to decide on implementing a CLT as part of our strategy. Overall, we focus on creating solutions that are upstream, and that meaning that we aim to change the underlying community conditions that cause challenges for community residents. And we also focus on groundwater approaches, which means that we enable the community members to drive their solutions. So we have um, uh, a big focus on shifting power to persons with lived experience in our coalition. We also focus on this sort of three-pronged overlapping Venn diagram approach of equitable opportunity, people, and place in our community development work. And if you only focus on one or two of those, you aren't able to create a resilient community. So for example, if you only focus on equitable opportunity, residents will obtain those opportunities and then move to other places of town. If you only focus on place, price of living in that place will rise and you could cause gentrification of community residents. So we really focus on all three areas in our community development approach. The next slide shows that our coalition has a four-pronged strategy, which is a community ambassador leadership training program, training proximate leaders in our community on how to access resources and share with their other community members, financial and housing counseling, community land trust, and home mortgage financing. So the next slide shows that I will first start talking about the community land trust. So if you move to the next slide, and now the next slide again, uh, the Silk Road, so the Community Land Trust is called the Silk Road Community Land Trust, and our journey began in 2022 when we were participated in a learning collaborative with Methodist Healthcare Ministries. We received technical assistance from LISC to learn about CLTs as a strategy to support wealth building within the community. And we did our first site visit to the first CLT in Texas, which is in Austin. In 2024, we did a site visit to the Twin Cities CLT network and were awarded implementation funding from various funders. In 2025, did site visit to the Greater Boston CLT network and did our really legal framework and foundational setup in terms of board structure revisions, bylaws revisions, creating our ground lease, and also worked with NALCAB to do spatial analysis. And I just want to call out that we engaged Jeff Washburn with Burlington Associates as our consultant in 2024, who's really been by our side, supporting us through a lot of this implementation work and expertise to support us. Next slide shows that in 2026, in February of this year, we were designated by the City of San Antonio ordinance as a community land trust per the state statute that Leela mentioned, and shortly thereafter were awarded $1.5 million in bond funding from the city to implement this solution for 10 homes throughout our Silk Road CLT region. The next slide shows our area. So this is Bexar County and the northwest portion of the city of San Antonio. The orange outline is the boundaries of our Silk Road CLT. And then you can see in the next slide that a large portion of um, individuals in our Silk Road area, particularly in the medical center area, which is the dark orange section, are renter occupied, majority renter occupied. And these are really the individuals that are sort of the backbone of our community. These are the nurses, the technicians, the teachers, the firefighters, and as they look to move into home ownership, on the next slide, you can see that that median household income over the last 15 years has increased at a slow rate, whereas median home value has increased at a much higher rate, meaning that many of these individuals who are renters are not able to obtain home ownership. And the next slide shows that a lot of these are also cost burdened renters. This slide shows the percentage that of renters paying more than 30% of their income towards housing costs. And so our CLT really aims to support, if you go to the next slide, those individuals that are the working class San Antonians that have built our communities into enabling them into obtain home ownership so that they can build uh, wealth for their families, they can build equity and generational wealth. And we do this through the Silk Road CLT, which removes land from the speculative market and places that under community stewardship and community ownership, and then creating permanently affordable housing on top of that. That aims to serve low income and moderate income households at uh, below 120% AMI. So in the next slide, you can see the area median income kind of distribution of our network and the target areas. And again, the different sort of thresholds are part of requirements that the state has set out for home ownership CLTs. So 25% of our homes will go to those less than 60% of AMI, and then others will go to those less than 80% of AMI, and some up to 120% of AMI. The next slide, it shows that we have in our business case plans to acquire 3 different types of homes, 2-bed, 1-bath, 3-bed, 2-bath, and 4-bed, 2-bath. And you can see that the anticipated acquisition cost is in the blue bar, and then we plan to invest rehab funding to support those homes with deferred maintenance, as well as to make the homes accessible to wheelchairs. And then we will sell the homes at an affordable price to income qualified home buyers. And so that is shown in the green bar. And those would become permanently affordable over time, where the ground lease dictates how those homeowners will retain some equity in the home over time. And when selling in the future, they would be selling to another income qualified home buyer, and some of that appreciation would retain with the home, thereby making it permanently affordable. The next slide shows that, so the fourth pillar of our strategy is focused on home mortgage financing. And so many of the community members in our coalition and in our Silk Road District CLT service area have prohibitions on obtaining interest-based or traditional mortgages for personal cultural values reasons. Therefore, part of our strategy is to implement a partnership-based or a non-interest-based mortgage product where the sharing of risk and reward or I should say risk and reward are more equally shared between the credit provider and the homeowner. And that enables individuals in our service area to have both an affordable home through the Community Land Trust and a mortgage that doesn't compromise their personal values. And we are looking for a partner, a mortgage provider that can partner with our community land trust to provide these types of mortgage products that are not interest-based. So if anybody is interested, any mortgage providers or lenders are interested, welcome you to contact me at here's my email address and my phone number. So with that, I will hand it to Alex.
Thanks, Nadia. Uh, Great. Thank you, Julia. Hi, everyone. Good afternoon. Good morning, I guess, for some folks. My name is Alex Cabral. I'm with Grounded Solutions Network. Before my role at Grounded Solutions, where I support shared equity programs with real estate and financing strategies, I was a lender. Most recently, I was the director of lending at National Housing Trust. They're a national community development financial institution based in DC. I believe they still have the largest portfolio of community land trusts and limited equity housing cooperatives, which is what I was managing before moving here to Grounded Solutions Network. So I'm going to provide a brief overview of lending to shared equity models in a way that I wish it would have been introduced to me when I was a lender, and how I wish folks would introduce it to their lenders. Because sometimes it seems like we get lost in the terminology if it's unfamiliar to us. We're missing the forest for the trees when in reality, these housing models, community land trusts, shared equity programs, are more familiar than we think. And along the way, I'll include questions that, as a lender, you can ask your candidate borrower throughout the diligence and underwriting process. And as a borrower, I encourage you to make sure that your lender understands the answers to those questions so that there are no surprises down the line. Next slide, please, Julia. Who is Grounded Solutions Network? We're a national nonprofit. We're focused on scaling housing with lasting affordability. So when I say housing with lasting affordability, this is a general term referring to shared equity programs like community land trusts, limited equity, housing cooperatives, deed restricted housing, inclusionary zoning. I'll get into more into these models in a second. We support the sector fairly comprehensively. We're a membership organization with over 300 members across the US. On behalf of our members and the sector as a whole, we provide policy advocacy at the federal, state, and regional level. We have a proprietary asset management impact tracking platform built on top of Salesforce specifically for this sector, and we provide technical assistance for housing organizations, policymakers, funders, everything from growing their knowledge on shared equity programs to growing their shared equity housing portfolios. And here are some of our clients down below. Next slide, please. Okay, let's get a lay of the landscape. What is shared equity housing? Uh, you might hear terms like housing with lasting affordability, permanent affordability, shared equity housing. These are often used interchangeably. I'm going to say shared equity for this presentation, just as it's the shortest to say. And shared equity balances the benefits of individual ownership and wealth building with community benefits of stewarding a community asset with lasting affordability and keeping it affordable and a quality home in the community. So shared equity's umbrella term, I mentioned some models that fall under this term, like community land trusts, resident-owned communities, limited equity housing cooperatives. You see them down on the screen. And sometimes these multiple of these models exist in one housing project. So you can have a limited equity housing cooperative that sits on land owned by Community Land Trust and is part of the Community Land Trust portfolio. So um, we can get more into that in the Q&A. If you'll have questions, I'm happy to answer. Next slide, please. Okay, this is something that I wish I would have known from the jump, is that there is technically kind of a traditionally recognized shared equity model. They have a few things in common that you can look for to better understand the type of model that the organization is using. So most shared equity models, and when I say most, like over 90, 99%, have an affordability requirement attached to the property. It's usually 99 years. There's a legal agreement that outlines the terms of affordability and that the affordability renews upon resale, that the shared equity program has the right to repurchase the home if it's being sold. So they have the right of first refusal. And homeowners can't buy themselves out of the program. They can't buy the house out of the shared equity program. So when click, Julia, please. Question you can ask yourself as a lender, make sure your lender knows. Does your shared equity program have the characteristics of a traditional program, that they may or may not know? And then you can ask, can I review your legal documents to verify? Next slide, please. Speaking of legal documents, there are a few commonly used legal agreements in this space. The most common is a ground lease. Deed restrictions are also common, and if it's a limited equity housing cooperative, it's likely the articles of incorporation. So all of these documents will include the clauses I just mentioned, and I pulled out some of the phrases from each of the documents just to give some examples. But this is likely what you'll see when working with the shared equity model. Next slide, please. Okay, let's talk about the models themselves briefly. So I've included some differences here. A limited equity housing cooperative is a nonprofit ownership entity itself. It's democratically governed by its members who own shares of the cooperative, and the cooperative entity owns the real estate. And as I mentioned, they're often relying on their articles of incorporation, operating agreement. They might not have a ground lease or a deed restriction, and they usually don't need one to meet this shared equity criteria. It's spelled out in their other legal agreements. A community land trust is also its own entity, usually a 501(c)(3 or a nonprofit. Community land trusts use usually ground leases and deed restrictions to manage their properties. And community land trusts aren't just for housing. They're also for commercial spaces, community spaces, health clinics, urban gardens, et cetera, et cetera. And then you have just kind of a more general shared equity program, and this can be housed within an organization. It can be a nonprofit or a for-profit. A lot of Habitat for Humanities have shared equity programs within their greater model, and they're also using ground leases and deed restrictions to steward their properties. One click, Julia, please. So, a question you can ask yourself as a lender, or you can ask the candidate borrower is, what type of shared equity model are you using for this project? Have you used that model previously? Is it your first time? It's just getting some familiarity with their familiarity about this model. Next slide, please. Okay, I'm going to run through 3 common questions that typically come up when discussing these types of models with lenders. The first one is, how does the long-term affordability affect my collateral? We know that lenders are very concerned about their collateral, understandably. That's how they get repaid sometimes. So there are a few sub-questions to this first question because depending on the timing of the ground lease, the deed restriction, the legal agreement, you may not have to worry about it. So the first question you'd ask is, does the land or the subsidy have affordability restrictions? If the land or subsidy does have affordability restrictions, you would treat this the same as other affordable housing loans that you make that come with affordability requirements, right? This is a pretty common scenario in our space. So now's not the presentation to tell anyone how to change their underwriting. Many of you are familiar with how to work with this, and just an example, when I was in lending and we would come across the scenario where the land or the subsidy would come with affordability requirements, we would get an appraisal that asked for both the unrestricted and restricted values, and then we would underwrite and size the loan from there based on our credit policy. The second question, if say let's say the answer is no, there are no affordability requirements on the land or the subsidy, it was donated or fundraised or something like that. Then the only affordability requirements come with the ground lease or whatever legal agreement the shared equity program is using. Sometimes these legal agreements aren't put into place until the home is sold to the home buyer. Sometimes the shared equity program will choose to put the ground lease into place immediately once they purchase the property. So, one click, Julia, please. A question you can ask as a lender is, will there be any affordability covenants in place during my loan term? And if so, what are they? And when do you expect them to come into play? Just again, getting yourself familiar with the collateral and the loan. Next slide, please. Okay, we have another collateral question here. How does the ground lease affect my collateral? Quick reminder for folks, don't fear the ground lease. Leasehold structures are fairly common in real estate. They're more common in commercial, but they're being used much more frequently for residential. I put some examples up here of well-known corporations that use ground leases or are on a ground lease oftentimes. And so I just want to say that shared equity properties are valued at market rate. And this is because in a foreclosure scenario, both the ground lease and deed restriction convert the property back to market rate, and the affordability covenants are wiped away. So in the case of a ground lease, the ground lease turns into a market rate ground lease. And in the case of a deed restriction, the deed restriction is wiped away completely from the property and it can be sold on the market as fee simple. So happy to clarify any questions there, but I think that often answers a lot of questions lingering in minds of lenders. Next slide, please, Julia. Okay, and the last question I have here, can shared equity homeowners qualify for a mortgage? They can access mortgages in the traditional mortgage market. There are some mortgage providers that are more familiar with shared equity programs than others, and Grounded Solutions Network maintains a list of national shared equity mortgage lenders. If you're looking for a loan or a peer to discuss this with, so please reach out if you'd like that list. And there are a few important things to understand when talking about shared equity mortgages. The mortgage lender, like any mortgage lender, needs to understand the ground lease or the deed restriction, how it impacts the collateral and their underwriting, and also, right, understand the borrower and make sure the mortgage product meets the shared equity homeowner's needs. Another important point, Grounded Solutions created a template ground lease and a template deed restriction alongside Freddie Mac and Fannie Mae. Both Fannie and Freddie have approved these templates for use, meaning that shared equity mortgages qualify to be sold on the secondary market. So mortgage lenders have the option of keeping these loans in their portfolio or selling them to Fannie and Freddie. You just can't veer too far from the approved template. So make sure you get some lawyer eyes on that as well. And one last thing is Fannie and Freddie Fannie produced a shared equity certification program. So shared equity organizations can be certified under Fannie and Freddie, which gives mortgage lenders a lot more confidence that their template documents do abide by what Fannie and Freddie have originally approved. So as a lender, you can ask yourself or ask the candidate, who developed your ground lease and deed restriction, and can our lawyer compare it to the template documents to ensure it's not too modified, Is your program certified by Fannie Mae? Next slide, please. Why lending to CLTs and shared equity programs is a good bet. Shared equity programs often have close connections to public agencies and representatives and their communities, more so, I will say, than traditional affordable housing developers. So this can mean there's little to no community pushback for new projects. Maybe the government bureaucracy goes a bit smoother. Another thing to keep in mind, shared equity programs act as a long-term financial backstop for all of the properties in their portfolio because they're often on the deed. So they will be notified by the mortgage lender if payments are missed. And the shared equity program will likely know if the homeowner is going to miss the mortgage payment, maybe even before the lender notifies them. And this is a very strong investment. One investment into a community land trust home, on average, benefits about 15 families over the course of the 99-year ground lease. So it's a lot of bang for your buck there. And last slide, please. Okay, so here's some resources. I mentioned some of them throughout the presentation. They're linked here at the bottom, and I think we're probably sharing these slides afterwards. And I'd also like to mention that Grounded Solutions launched our Southwest Hub this year. We're deeply investing and being really intentional in Texas, Colorado, Oklahoma, and New Mexico. We just hired a regional hub manager based out of the Denver area. Feel free to contact Tiana and reach out if you have any questions. And our activities in that area cover everything from consulting on shared equity housing projects, solving financing challenges for Native communities, developing products with state HFAs to support shared equity programs, and supporting policy advocacy in 2027. Thank you all. I'll pass it on.
Great. Thank you, Alex. And thank you also, Nadia, for your great presentations. I'm happy to turn it over to Sarah and Bill, who did an excellent CLT lending presentation at the Midwest CLT conference and are gracious enough to reprise it for us here.
All right, I'll start with, I'm Sarah Whitley. I'm a loan officer with Johnson Financial Group and have been working with the Madison Area Community Land Trust in our area of Wisconsin for about the last 15 years. Go ahead, Bill.
And I'm Bill Kopka. I am a community development banker at Associated Bank, and I got my intro to community land trust as a lending manager, mortgage lending manager on a portfolio product for a large national lender. Learned the ropes there, bought into the concept because I saw that it preserved a whole bunch of subsidy that was otherwise not staying in communities, neighborhoods, and properties that were benefiting from them initially. So anyway, learned as a lending manager and had every single community land trust deal land on my desk before it got final approved at some point. We did quite a few of them, including in Texas. So now I've been on the board of a couple community land trusts, and I help advocate within the state of Wisconsin for the cause around community land trusts at every chance I get. So thank you guys for having us, and bear with us because some of our content's a little bit Wisconsin specific, but it might help you understand it's a nascent community. Our CLT community here really is not yet robust, but it is growing fast with a great appetite and great growth. So we are an example of a region that has grabbed onto the existing model and has begun to advocate for it in our state. So that's what you're going to hear from us a little bit. If it gets a little too Wisconsin-y for you, I apologize, but there's some things that we're going to share that are specific to our market.
Okay. Next, so how could CLT lending help my affordable lending performance? And that's what you would ask the lender, or the lender would be like, how is this going to help me? So help me help you. So how it helps a lender is it aligns with the Community Reinvestment Act, which was created after the Fair Housing laws to help make sure lenders are abiding by the fair housing laws, that we're providing housing to low and moderate income families, and we're also to different demographics along the way. So this is one way a lender, this is how lending to CLTs can benefit them. And lenders also like to work with philanthropic partners as well, and supporting a CLT through, well, not just with funding ways, well, funding like because they're a 501c3 nonprofit, but also lenders like to help teach homebuyer education, getting homebuyers ready, which we'll talk about in a later slide, to become a homeowner by doing financial literacy. There's many steps that a lender can benefit by working with the CLT. In the next example, if you want to go to the next slide, we're going to talk about how these can even be made more affordable with partnering with other agencies to provide down payment assistance. So in this slide, like Bill said, this is very Wisconsin-centric presentation, but just to show you, we have two completely different areas in Wisconsin. Madison area, we are the state capital. We have probably as in 80% AMI, we're the highest income limits in the entire state of Wisconsin. We're in Milwaukee, Wisconsin, if you guys all know the Bucks, is about an hour and a half away from Madison. And it was one of the hardest hit areas in the entire nation during the market crash of 2008, 2010. But how even those two separate areas with the purchase price just for the Madison area, this was a newly built home in Madison. The purchase price was $295, appraised value was $405. So that gap helped, but these people still needed some additional funding to make the home even more affordable. So they got, what is that, 50, I can't do the math right now, $68,000 of down payment assistance to make the home even more affordable, even after the ground lease and being part of the CLT. And then with the Milwaukee, a lot of, I want to say the area median income has to be at least $30,000 less for an individual versus Dane County, which is Madison area. So those people also still needed subsidy to make that home a little bit more affordable. But just to show you, there is that range. What Nadia shared, that was really great information. But just to show like those two different areas, they still need additional subsidy to make it more affordable, but how this can truly help somebody into home ownership and get to the next step. Say this is your first home, 5 to 10 years, move up to your second home, and a way to start building wealth. You can go to the next slide now. And as Alex said before, Fannie Mae and Freddie Mac, they actually, these are saleable loans that Fannie Mae and Freddie Mac do allow in the secondary market. And Freddie Mac actually, I switched over to Johnson Financial Group about 3.5 years ago. My previous lender, we were actually financing community land trust deals before Fannie and Freddie were allowing them. So they already knew all about it, but I had to come to Johnson Financial Group and educate them and learn that Freddie Mac actually has classes for underwriters, for closers, processors, to teach the people who are in the background of everything, how a community land trust works, what documentation do we need on the lending side. So it's less work for the community land trust themselves to actually explain that to the lender, because there's certain things that you're not going to be able to explain to a lender what they need to hear. So there are resources out there that will help you help them understand what a community land trust is and what they need to have on their side of things. If you want to go to the next slide, and I'll let Bill take over from there.
Yeah, I want to piggyback a little bit on one of the items that Sarah was talking about, and that's like what's in it for the bank, what's in it for a lender to support community land trusts. And if you think about if there's folks in the poll that are focused on CRA strategy and fair lending strategy within the banks, that has bankers, and in the case of CRA, specifically bankers, credit unions don't have CRA, nor do brokers, mortgage brokers, but all of us have fair lending. In the case of both of these, it's tough for each lender to acquire and build to self-generate, organically originate enough volume for CRA and fair lending to satisfy their regulators sometimes. Depends, market to market. And so lenders have to have this quiver full of arrows of different strategies to help penetrate the market and meet those needs. And I'm going to just for a second go and talk about those other strategies that I've seen happen, like purchasing loans through third-party origination or wholesale channels. They'll buy loans to meet the CRA risk needs. That means that they're buying loans they didn't originate themselves, maybe wouldn't have originated themselves for borrower profiles that didn't fit their original credit profile. That means a bank's buying a riskier loan sometimes than they would have made in order to fill their CRA need. That's risky. That's not a perfect solution. Sometimes they buy loans from Habitat. Habitat tends to originate loans at 0%. When you buy loans from a Habitat, you may have to discount the loan when you purchase it. But a bank has all these different strategies to get new loans on its books to help it perform for CRA. And I want to tell you that community land trusts, as complicated as this whole thing might sound, if you're not familiar with them yet, they're a unique, better tool, in my opinion, from a mortgage perspective for a bank, for balance sheet risk, because they're saleable loans at market rate. And almost always, not exclusively, but almost always to households with under 80% area median income, making them CRA eligible loans. On top of that, there tends to be a social justice component to community land trusts where they're serving harder to serve communities that are historically disenfranchised. And hence, I'm going to use sensitive language here. We're talking about fair lending, which ties to race, culture, heritage. It's hard for a lender to go out and get the loans that fit all these things that a regulator wants us to have, but land trusts tend to be a partner where if you happen to originate a loan for a land trust borrower, odds are it's a low and moderate income borrower from a historically underserved community. And from a risk perspective on your scorecard for CRA and fair lending, you're able to fill two risk components that a regulator might ask you to demonstrate you're serving within your market. So land trusts can help you in that space too. That's a little off script from what we're talking about here, but I wanted to sell that value of what's in it for a lender to get involved with land trust lending, because it is much cheaper, lower risk than buying loans from other places. So that's my soapbox. Okay, now, roles for lenders. If you're going to get into the community land trust game, I can tell you from experience, having been a lending manager in this space, that you're going to have role-specific training to make all of your colleagues that are going to be involved in this process aware of what a land trust is, from the sales side all the way to the servicing side. So once you originate a loan and you're servicing that loan in the future, everybody that touches a community land trust loan needs to understand it's a community land trust loan, and it may have some unique handling characteristics. So on the sales side, the sales people at the banks are really, really good at going out and saying, yeah, we want to do community land trust lending. But you got to check them. If you're working with them first and they have a great appetite, you got to say, hey, when we meet with you, we the community land trust that's looking for new lenders, when we meet with you, could you bring along your underwriting team so that they can hear what we're talking about too? And they can also learn and attest to the fact that your bank as an institution can support our borrower through the entire life of home ownership. It's important that you don't just have buy-in at the sales level. But the salespeople, the mortgage loan officers, are the ones you're most likely to first build your relationship with. In my banks, both banks I've worked in that do community land trust lending, and my current bank I pooled into doing community land trust lending, it's really important on the origination side that we identify this as a community land trust loan right up front. It affects a whole bunch of different things for vendor ordering when you're originating a mortgage. Most importantly, and I'll probably repeat this 5 times, I heard Alex talk about it, the appraisal is a big tripping point for a lot of originators when you do a land trust loan. So your loan officer has to upfront identify that this is a land trust loan so that a appraisal is ordered specific for community land trust. the loan officer will also counsel the borrower on the CLT and help them with loan structure. And they'll ensure that the borrower meets all requirements of any down payment assistance, community land trust requirements, income limits. The loan officer is going to be responsible for helping demonstrate eligibility for that borrower in all those spaces. And they're also likely, the loan officer is most likely to work with the land trust as the front of the bank with this relationship. But on
Hey,
the
Bill, do you
operations
want
side,
to answer
what's that?
Jeff's question really quick? Jeff answered a question, and I think since you're touching on this part, you could probably answer it.
Could you read it to me? Because I'm not sure I see it at the moment.
Sure. His question was, Bill, Sarah, do you face any internal challenges getting your respective institutions comfortable with CLT lending, and what are your selling points?
Yeah, absolutely.
And
The
since
answer
you
is
had to sell this to your bank, I would love for you to touch on this.
I built a deck.
He did.
and and I started that deck with what's in it for us, and it
Mhm.
sounded a little bit like what I talked through just now. But I also had to identify what's the market opportunity in our footprint, our bank's footprint. How many land trusts are there? How many units do those land trusts originate per year? How many borrowers go through them? Because the bank, it's a heavy lift to start any new program with most banks. And in order to make this palatable for my bank, I had to demonstrate that one, there was a market need to do a unique type of lending that we don't already do. Two, that it was doable, that we had the infrastructure in place that we could do it. Three, that it's lower risk, and I was able to demonstrate that it's lower risk than buying a 0% habitat loan, although I do still support that too. And there's a business case that needs to be made, and you need to demonstrate it really probably to your operational risk people first. Your sales team will fall in behind it because they see it as a new stream of origination opportunity. But you need to make sure that your credit risk groups understand it. And as soon as you say the magic words that you've heard a few times already are, it's saleable on the secondary market. As soon as you get to that, a lot of relaxation might come through your secondary markets team that's responsible for securitizing and selling mortgages. These can be securitized and sold and still managed. The answer is yes, there's hesitation within each lender to start doing something new and different. The answer is yes. And hopefully through this conversation, we'll help you create, like T-ball, we'll put this out there for you to be able to take back to your lender and make a proposal to that extent. I had to do that in my bank. So I hope that answers the question. Picking back up on the operations side, I already talked about your loan officer has to be specially trained so they understand what they're doing. Your processor, who might order your appraisal, your title, these types of things, they need to understand what a land trust is. That means that the loan officer needed to tell them what it is. That means that the loan system needed to be marked to say it's a land trust or a leasehold property so that they know how to order specialized products for this loan. Your closer, when it gets to that point in the process, needs to know how to proof our LTV calculations. There's a lot of subsidy in these deals. It's different than down payment assistance, the way it's structured on your closing settlement statement. And it can confuse a closer at the end where they're double checking numbers to make sure that we're within program requirements of 105% maximum CLTV. They get a little freaked out sometimes when they look at the way a CLT is structured, a CLT deal is structured. It looks to them like it might be more than 105% CLTV because they're used to calculating that on the lesser of sales price or appraised value, when in fact, because of Fannie and Freddie's guidelines, we don't calculate it on the lesser of those two values. It's a little different for them. So your closers need to understand it. Can we go to next slide? Oh, there's also a ground lease rider that the closer needs to be able to prepare, and that goes in each deal that's a little bit different. On the underwriting side, this logic just follows. The underwriters need to understand everything's a little different. CLTVs are a little bit different. The down payment assistance and the subsidy stacked a little bit differently. The appraisal that's being underwritten, there is a specific methodology outlined in Fannie and Freddie's selling guides that needs to be followed depending on who you might intend to sell it to. And not every lender sells their CLT loans to Fannie and Freddie. Many of them do portfolio of those loans, including credit unions and other brokers. They have a duty to serve, and they're interested in doing these deals even if they don't sell them, because they understand that these tend to be lower risk because of less LTV than many deals, and because there is a stewardship component that the land trust is supporting the home buyer if they stumble and struggle. They know there's a nonprofit behind them providing stewardship support. So anyway, the underwriting also might include the initial underwrite of the CLT's balance sheet as a corporation, as a separate entity. Lenders want to make sure that they're getting in business with a community land trust that has the capacity to be around for the term of a 99-year ground lease. That's a big deal. So we the lenders, because of Fannie and Freddie and their requirements, have a vetting process for each new community land trust, and often underwriting, whether it's the consumer underwriter that does the mortgage or your bank's commercial underwriting group, they may be looking at the balance sheet of the land trust to initially approve doing business with a land trust. Okay, and then finally servicing. In the worst case scenario, this is what every lender always thinks about is, oh my God, if we have to foreclose on a property, can we foreclose on one of these CLT properties? And the answer to this is yes, but, and there's a few little nuances in here where the land trust actually has first right of refusal, and they might bail out their borrower and they may cure the mortgage default. And in servicing, one of my experiences has been that there is an agreement that we ask our borrowers doing a land trust property loan to allow us to disclose their loan performance to the third-party community land trust. That's a separate legal entity. That's not typical in servicing that we disclose loan performance to any third party. There's a customer confidentiality piece that is typical with all other mortgages. But in the land trust space, we ask our borrowers at closing of their mortgage, if you default, can we call the land trust too? And the point there is they're a partner. They're there to help us help you succeed as a homeowner. And we want the land trust to know Mrs. Smith is 35 days late. Can you do early intervention? Can you help her? Can we work together to prevent a 60-day past due, a foreclosure proceeding? So in servicing, there's actually agreement that sometimes there are some agreements that I've seen get set up where loan servicing reports to the land trust about homeowners in their portfolio, so that land trust knows how our borrower is doing. That's something I'd say is a best practice to ask your lenders if they're willing to do it. Kind of good news if you can get it. Land trusts have first right of refusal when a property gets sold. That means they can buy the house, they can cure the mortgage, they can do a whole bunch of things to prevent it from going to foreclosure. In a lender's perspective, they like this first right of refusal with a low to moderate income borrower because it prevents them from having to go into foreclosure on what could be a high reputational risk foreclosure if it gets messy. Banks don't want to cause anybody harm through foreclosure, and we like that there's a nonprofit to help us there and maybe even step in and cure a default and take over a loan or take over resale of a loan to a performing new borrower. And then finally, what I'll say is we talk about deed restrictions, and this scares lenders too until they understand each particular deed restriction. Be aware that deed restrictions evaporate upon foreclosure, but the CLT retains ownership of the underlying land, and they have the right to raise the monthly land lease to market rate. So worst case scenario, which I've never personally seen happen in more than 15 years of working with community land trust borrowers, when it goes to foreclosure, if we did foreclose on a loan, we are still partnering, we the lender in servicing are still partnering with the land trust long term to make sure they still own the land under our home, and our borrower now that doesn't have to be deed restricted in the case of resale, they're still going to have to pay an underlying ground lease fee. That's a worst case scenario, like how would it happen if everything went to pot? And it's important for lenders and credit risk to understand that that's a worst case scenario, but your collateral position is protected, and there's so much subsidy in a land trust deal that makes our loan to values really low relative to the market value of a property. And because of all of that sunk subsidy by the nonprofits and often government entities, there is a great motivation not to lose that property from permanent affordability and allow it to go to foreclosure. It's very rare that might happen. Okay, so if we go next slide and we talk about challenges for lenders, I talked about a couple of these, but it's really important that you order title correctly and that you have an appraiser panel. An appraiser panel is funny speak for more than one appraiser in your market that understands community land trust appraisal valuation methodology as defined by Fannie and Freddie. Is there
I
someone
want
ask a question?
Yeah, there's actually quite a few questions actually about appraisals that are, well, a couple of them. And I just want to touch on is a standard appraiser doesn't know how to appraise a shared equity property. So that was another thing that when I came over to my current employer, because there was a lull in community land trust financing for a short time because of the market crash and everything. But we actually reached out to our current appraisal panel. So like we have, 20 appraisers, and we're like, hey, we're starting to work with these local community land trust. Are any of you able to or knowledgeable on financing or appraising community land trust properties? We had one appraiser that appraised throughout the entire state of Wisconsin that went and sent every single one of their appraisers to the CLT training so they would know how to appraise these properties. So there's specific training on how to appraise CLT properties or shared equity properties. So that kind of answers, I think, one. So it's not our specific banks. Our appraisers are all third party people that give their personal opinion on value. The one of the questions, Bill, was regarding like how does is it based on market value or the CLT, the lot price? If you want to touch on that part a little bit. How is the lot price factored in? It's market rate is what the value is actually used for the property.
Yeah,
But
so
then, go ahead.
in the appraisal, there is, if you think about it this way, if you are buying a home on a leased lot, there's still inherent value to that leased lot. And when the appraiser evaluates value, there is the value of the structure and there's the value of the house in the location in that neighborhood on that lot that they have dedicated 99-year rights to. And so it is not as valuable. So what I'll tell you is that the appraiser methodology determines that a lot is not as valuable as the fair market value of if that lot were vacant, but it's also not zero. It's very nearly as much as the fair market value of that vacant lot because there's value to that lot's location where that house is and it's stationary and will be there forever. And there's value 99 years of lease access by that homeowner to that lot. There's value in that too. So contrary to what a lot of underwriters that I've trained have thought, when you evaluate a land trust property, my experience is that the land trust leasehold value of that property is like 95 or more percent of the fair market value of that property were it not a community land trust property. Sarah, is that nearly similar to your experience?
Yeah, exactly.
So you don't just subtract out the land value to come up with the value. That is not the methodology.
Yeah.
There is value in that loss, that the access to that lease for the lot underneath the home.
I think the concern was, that there is still value in that lot. It's not zero. So yeah, but it's the next question is how do you get an appraiser to correct it? And you have to work appraiser who actually understands how to appraise a shared equity property, like I mentioned.
My experience is that as a lender, we know who our appraisal companies are. And when we get into the land trust lending business, it's incumbent on us to contact the appraisal company and ask them, do they have anyone already knowledgeable on land trust lending? And or could they attend, I can't remember what the national appraisers network is called. I can't remember it off the top of my head, but they actually have a land trust module to train appraisers on land trusts and evaluating land trusts. But better than that, Fannie and Freddie Selling Guide gives you pretty clear guidance on how to value the property. The appraisers that haven't done them before struggle with them. It's a point of fact. I don't know, I can't make that go away and be easier, but once you do have an appraiser trained in your market, that becomes a golden partner for you long term, and you want more than one. So new land trusts in new markets where land trusts have never existed before, this is a big hump that you have to overcome. And I see a question also about touching on lending for acquisition and construction of units, slightly different than providing CLT mortgages. And for kicks here, I haven't done a lot of construction lending. I have done it within a condo project in the past. It's been more than 10 years, so my knowledge is maybe a little dated. Alex or Sarah, do you have insight about working with new construction that you could help me answer that one?
I have experience doing, generally project lending. I'm wondering, the question says touch on it. Is that question asker available to be more specific on the question?
Yeah, Tina, are you able to put in the Q&A a little more about what you're curious about?
I guess while we wait for that, I will tell you it's absolutely common and it happens that new construction lending works with community land trusts. It is not something that it's come up a lot. In fact, there are developments. I'm going to cite one in New Mexico, the Sawmill Community Land Trust, which it's been more than 10 years since I worked with them. They built a whole development of community land trust properties that were both common wall, single family units, and condo. And that development it was all new construction. So like it is possible. So anyway, I'll pause there and see if we have clarification on our question.
That's a good start, Bill, too. I didn't make room for the pause. So, but I was just going to say, I think we often assume when we hear CLT or shared equity program, we think of a single home or one lot, but the reality is that shared equity programs build single family, multifamily homeownership, rental, condos, townhomes, subdivisions. They use new market tax credits. They use LIHTC. These are affordable housing developers, and the difference comes when you sell the home and it's put on a ground lease or a deed restriction to keep it affordable for 99 years instead of 15.
Yeah.
Thanks, Alex. And I'm going to ask us. Let's let Sarah go to our next slide, and then we'll wait for our Q&A too.
Oh, look, sorry. I was reading the question here. What are the collateral issues? Okay, but so some of the risk is that there is a special skill set for a lender and a company to do that. That's what would be one risk, and that's why it's important to have all parties at the lending institution to get trained on this. And that's I'm really glad that this training is available at I would have to do a lot of the training otherwise, which and I don't know everything. But so there's extra labor, like extra work that needs to be done. And things are always changing. Currently with Madison Area Community Land Trust, who I partner with a lot here, they have 2 condo projects in Madison, and they are currently switching. They had each condo units on ground leases, and now they're switching as they sell over to deed restrictions. So that was a learning curve for me this year. Which it makes sense because the ground lease is actually between the condo association and Madison Area Community Land Trust. So putting the deed restrictions makes a little bit more sense. So they're things are always changing and perfecting. So it's a learning experience. There is sometimes more than one touch. Another learning thing that has recently changed with condo approvals for community land trust, both Fannie Mae and Freddie Mac have an additional layer. So approving the condo, but also approving the CLT with the condo has been a new thing. Freddie Mac was the only required it, but Fannie Mae just recently started requiring to approve the condo project and the CLT as one. It does help, like Alex mentioned, the Fannie Mae list of the approved community land trusts. So, if they're already on there, but there's another layer that was recently added as well. But there is a lengthy amount of benefits to do these loans. I personally have had, I think, about 3 homeowners that had originally purchased with the CLT, and they've upgraded into their own single family house or other home and use that equity that they had built, even though it's limited equity, to purchase a new home. So it's really great, and it's a really it really gets people into home ownership. And I'm seeing more and more, like in Madison, as it becomes more and more unaffordable, it's helping more and people into home ownership that might not have had the opportunity to begin with. Going back to the you get a kickback from lenders sometimes, but you need to, I like to drive in the CRA related part of it, because these are CRA related properties, the applicants, and sometimes the demographics. Like there's so much CRA credit that a lender can get from financing or working with a CLT. It helps with neighborhood. I feel like Alex touched on all these benefits when she did her presentation. So I won't touch on it again, but yeah, I feel like Alex, you covered all of them, and thank you for doing that. So you can go over to the next slide. And how I kind of talked about with the CRA related side of it too, and the philanthropic partnerships is doing, as a lender, we want to be out there and getting on the sales side of it, bringing more customers into the bank and doing financial literacy workshops. Sometimes, we have to go to the people to do these financial literacy workshops. Not there's a lot of unbanked people that might not feel comfortable coming into financial institutions. So this gives us an opportunity to partner with a nonprofit and do these financial literacy workshops, along with partnering to do homebuyer education, which most CLTs require you to do HUD certified education. And then the CLTs do their own specialized focus education as well. But there's many steps for a home buyer to be ready to purchase CLT property. I've learned with some first-time home, it's overwhelming purchasing your first house as a first-time home buyer, but with CLTs, there's additional layers. So if you have somebody like a borrower or a client that is like, hey, I'm looking into affordable housing, I'm learning that we have a new CLT, like starting with financial literacy and homebuyer education first, so they kind of understand that, and then doing the specialization with, this is what else is involved with CLT beyond the normal home ownership things. You can go to the next slide. So this goes into our Midwest opportunity. So we are growing in the Midwest. I'm going to go over to the next slide just to show you in Wisconsin alone. So currently, I think we actually have one more, I believe, that has the Green Bay.
That one's live. I'm on their board.
Yep, that one's live now. Yep. So as you can see, it has grown substantially. I think Madison Area Community Land Trust has been around the longest, and you can see the lull in there for a few years, but now people are realizing this is a way to keep homes affordable. So yeah, up 40% since 2018 on CLT growth. So I know Door County created their land trust. It's a very it's a lot of vacation people up there, but there's a lot of people that need to live in that area to help with why are the words not coming in my brain?
Service industry for vacationers.
Service
right?
industry. Thank you. Service industry people.
Waiters, and think about other
Yes.
places. This isn't Door County, but your ski resort operators. Like you got to have affordable housing in nice places. And Door County's that little thumb that sticks up into the right corner here that we're looking at. It's surrounded by water. It's a tourist attraction. You got to be able to live there, to work there, to be able to go there and enjoy there. You got to have everybody of every income level supported.
Yeah, yep, exactly. So you can see the growth just alone in Wisconsin has, I know it's grown significantly in Michigan as well. Just to show you a little idea, this is going to be Texas next year, and or the next couple years to come. I want to see your smiley face map. You can go over to the next slide. So just some key takeaways. There are opportunities, and lenders do want to work with CLTs. It's just we wanted to provide you some, actually just some basic knowledge of what lenders need to know. And there are opportunities out there for you to say like, well, here's something so you can learn more about it. Because as a CLT, you know what the CLT needs to know. You don't know what the lender needs to know. But there's many benefits that a lender can benefit, not just doing the loan itself, but as I mentioned, with doing that, those education purposes and doing those partnerships can really help a benefit as well. Did you want to touch on any key takeaways as well, Bill?
Yeah, as if you're a lender and you're gonna work with land trusts because you think it might be a better opportunity than some of the other ways you've had to go get LMI and fair lending volume,
Mm-hmm.
support the land trust, support their balance sheet, give them like get your philanthropic team to go meet with them. I promise you, everything they do is CRA eligible, which is what your banks generally care about with their philanthropy.
Mm-hmm.
Make sure you're supporting them. It doesn't have to be, I mean, it'd be great if it were 6 digits and more, but I'll tell you, my bank's a regional bank, a few states, and our grant support for the land trust that we work with is a few $1,000s. But each bank makes a difference supporting the balance sheets of these land trusts so that they can hire an initial, even part-time executive director to get things off the ground, or hire the consultant to do the business case study to start one of these in your community.
Mm-hmm.
That's where I think my bank's small, modest grants have been catalytic in helping create new land trust infrastructure. So given the plug to land trusts in general, that banks, if you're gonna work with them and try and do the loans for these land trusts, support them, support the operations of those organizations.
I think we don't have anything else. The next slide's just our info.
So I think we're up to Q&A, and I think it's Julia's facilitating.
Yeah, we are up to Q&A. Just wanted to say thank you to you both for that presentation. It's so helpful, I think, to get a really concrete understanding of how to make that business case and just all the different steps that are involved, all the different teams that are involved within a lending institution to help. I think there's often with CLTs, there's often a talk of lenders not understanding what community land trust or shared equity is and their need for like broad education, which is true, but it's just very helpful always to have that really broken down and to learn about some of the different resources like the appraisal training link that folks put in the chat and other really tangible things so that we can see more loans to CLTs, both on the project financing side and on the mortgage side. And I saw that folks were really good about getting answers to these questions in the chat and answering some of the questions live, but there's a few I think we wanted to pull out just to make sure that folks had a chance to speak to them. So one was, I think just this question about limited equity housing co-ops, if they have a 99-year affordability requirement, do you recommend also including a CLT? What is the value of doing so? And I think we might hear a similar question, if we're talking about jurisdictions who have regulatory agreements who have longer affordability periods, say like 50 or 60 years, which I know has been the shift in California, also in New York, how do you then also make the case for the role of a CLT doing that long-term stewardship? And Alex, I saw you put a response here, but if you and also Leela wanted to add to that, be great.
I wanted to kick off by saying that I think sometimes a new tool comes along and people tend to think that tool might be the solution to all their issues. And so if there hasn't been a lot of deep education around the advantages or pluses and minuses, there isn't anything magical about a CLT that can make a transaction other than probably the tax exemption. And I love the call to support CLTs from our lending partners. That's also great. But there are the point of clarity at the beginning of the process is what are we trying to accomplish in the community? Are we trying to accomplish generational stability in for the families moving into the community? Are we trying to accomplish asset accumulation for a number of families over time? And understanding how your community's goals relate to the structure of the documents to establish the CLTs. I think that's a critical point. And I was interested in this because of the question around the project in LA. Why specifically are community residents calling for CLT opportunities? Is it an anti-displacement focus, or is it an asset accumulation focus for existing residents? Because those structures would be different. And I would love for someone to jump in and say, no, that's not right, or to elaborate on that.
I will kind of address this. Well said, Leila. From a maybe more technical perspective, in that what we're seeing often is a group of tenants that want to acquire their property because it's the landlord said they're going to sell, and so there's a little bit of a scramble. Limited equity housing cooperative, depending on your geography, feels like a great solution, and sometimes it is often the solution, or one of the only available. I will say, so I'll start off maybe with the less bright side is that limited equity housing co-ops require a lot of work. I mean, imagine getting off of your day job and then going home and making governance decisions with all of your neighbors. Right? And not only does it require a lot of investment mentally and emotionally to manage a building democratically with the folks that you live with, it's a limited equity co-op, so folks aren't always able to bring the money to the table needed to invest in the property that market rate co-ops have access to. And so you have to be very intentional with budgeting and financing. And most residents probably don't have a background in that. And so I'm bringing up these points to say it is a lifelong commitment to live in and start a limited equity co-op. And oftentimes we see the support fade over the years if there's not some kind of nonprofit attached to support that co-op. If that limited equity co-op doesn't decide to pay a consultant like month by month to help them review the financials and resolve conflict and stay on top of the property management, it's hard to manage, and that is a great role for a CLT to step into and say, we are experts in this, and we hired a staff member to help support you, run your board meetings, review your financials. Again, and if the limited equity co-op can't pay their monthly mortgage, the CLT has the first right of refusal to step in and buy the property and save it from foreclosure. So there are some technical, pros and cons. Creating a CLT just to manage a limited equity housing cooperative would be a pretty large feat if that's the only role for the CLT. You really got to think about how many nonprofit entities you want to manage.
Yeah, and I'm seeing that there's some more context shared about the LA project, which is that both an opportunity for residents to have homeownership opportunity. We also hear from residents in the community who represent 71% renters wanting more control of their housing. So exploring models to preserve affordable housing and as a vehicle for homeownership in the context of this large scale redevelopment. I think the original question too was just examples of private-public partnerships that might lead to some CLT development. And I think there certainly are CLTs who partner with, private mission-driven developers. There's a few here in New York, some of whom are doing housing, some of whom are doing commercial. I think it really depends on kind of the landscape of who can do the development piece of it, especially if it's a new CLT that's trying to kind of build their capacity to do development, or if that's their goal. Some CLTs kind of want to be in the stewardship role and primarily partner with developers for that piece of things. But I think that also includes like large scale projects. One more recent, very exciting example from here in New York is the Kingsbridge Armory redevelopment with Art Bronx, who has a CLT program. But for this huge project, they secured this historic co-development agreement and a 20% share of the ownership stake in this massive project that is going to lead to affordable housing as well as commercial and community space. So that's another example, I guess, to Lila's point of like, it may not always be a CLT. There's other ways to think about community ownership with some of these projects or like combining of different strategies to get towards larger community goals. And that's connected, I would say, to the question about commercial CLTs and as an anti-displacement strategy. We actually did a report a few years ago at LISC looking at commercial CLTs, which came about because of LISC San Antonio's interest in this topic. And there's been, I think, a lot more growth even from the few years that we wrote that report that include community land trust, but also other, community shareholding models, community investment cooperatives and things for commercial spaces. So can definitely share more resources on that. But also, I think Leela and Nadia, if you want to share, I think sort of how that came about in San Antonio and also how there's been, at least for Cultural Ring, like a shift more to the affordable housing piece for the moment, but that's also connected with this larger corridor work that you're doing.
And I'll just hop in and also say that the lack of the state statute is an issue because the state statute is what allows for the tax exemption. And one big step forward, I think, for us here locally was sitting down with the chief appraiser of the appraisal district and his team and getting a checklist from them, the checklist that they're going to be applying to CLTs to make sure that they can provide the exemption. So that kind of collaboration, I also would recommend to anyone outside of Bexar County to make sure that your appraisal district is understanding what's going on with the growth of CLTs. Nadia?
Yeah, sure. I want to say that we first learned about the CLT model in the commercial sense from first Leela and later more in depth from Julia when Leela brought that as a tool for the Business Development Organization Alliance, which Culturingo is a member, to explore. And so we actually spent much time with our coalition exploring commercial CLTs as a way to support wealth building for small business owners in our community. And our strategy shifted because a lot of the persons with lived experience in our community, some of whom were small business owners who saw the value in that, also realized or shared that the home ownership was really out of reach for them for many reasons. And it was really the visit to Austin that Leela and LISC sponsored, and which Methodist Healthcare's Ministries and City of San Antonio came along with us for. But it was when we went to Austin with the persons with lived experience to visit the homes that the first CLT in Texas have, which is Guadalupe Neighborhood Development Corporation, that we came home and the persons with lived experience said, "This is what we want. This is what we need. This is what we're missing." And this is like really where we see the most need initially for wealth building for our community. And so our strategy has shifted to this home ownership model. But to your point, Julia, we also have a focus at Culturingua on revitalization of the Wurzbach corridor, which is in this sort of core Silk Road Cultural Heritage District, and enabling small business owners in that corridor to have affordable access and long-term access to small business space and as a main street in our community. And so we are also still on a long-term basis hoping to expand into commercial CLTs to support small business owners in the long run. And I also want to just give a shout out both again to Leela and Julia because we wouldn't know about CLTs if it wasn't for both of you and for your leadership and support for us.
But thank you, Nadia. I want to touch on a point that we heard from residents when we did that trip with Rock, also the manufactured housing, the resident-owned cooperative that we visited. One of the things we heard was that even if residents living in a GNDC or ROC community does not allow for appreciation of your housing asset. It does stabilize and produce health benefits and then the ability to save money in other ways. So with that support from the co-op or the organization around you and that training that we've already touched on, even if the structure of a cooperative entity doesn't really allow for the individual resident to get the appreciation and the value of the property, it does allow for wealth accumulation because you're not being displaced, your housing costs are not increasing. So I think there's more a flexibility in the model than it might necessarily seem at first, because that is a pushback that some people will say, why would you be putting me into an ownership opportunity where I am not going to see any appreciation in the value of this property, even if I live here for 20 or 30 years?
Yeah, and I want to return the shout out back to Nadia and Nader at Cocharingua because it's been an incredible amount of work that Cocharingua has done in the last 4 years, and just seeing the city of San Antonio make its first capital awards ever to CLTs earlier this year and have Cocharingua as one of the groups selected for that is just so exciting to see. And it's a lot part of this like larger movement in Texas. I know there's a few Texas CLT coalition members on the call. So just huge congratulations and excited to see what you all do. We do have a hand raised that's I think been up for a while. Jamar, if you're still here and want to come off mute to ask your question, I'm going to click allow to talk. And you're muted. Oh, there you are.
Yeah, I'm sorry. It took me a minute. Good afternoon, everyone. Thank you so much. I just had a really quick question, and this is kind of a follow-up to what I was typing in on the chat or the Q&A session about valuation and about understanding what that bottom line house valuation is in terms of determining how you guys size the loan for a CLT home. Do you include land as part of the overall valuation to determine what your ratios are for acceptable loan to value ratio for providing a home? Or is it less the land and it's just based on the purchase price of that CLT home? So is it the market value, including the land as your bottom line valuation, or is it just whatever that CLT home price amount is?
We base it including the land value as well.
Okay, and then of that this is more like an appraiser type questions. Part B to that is it whatever the ground lease payments are at some kind of a cap rate to determine the land value?
No. I wish
I
I
know.
could.
I'm sorry. It's a little bit in the
No,
weeds.
like so, like for a
Mhm.
single family house, the land, what in Madison, our buyers are paying $75 a month. So no, it's not. Bill, do you want to?
Yeah, so I think I understand what you're asking, and it's a sophisticated appraiser question. And
Yes.
there is a cap rate calculation that goes into the appraiser's valuation of the land. And what I'm going to advise you to do is, for a quick answer with it in black and white, Google Fannie Mae Community Land Trust appraisal requirements. Now, Freddie and Fannie differ a little bit, but you can do that for both, and you can find that guidance there that an appraiser would follow. That's like a level 300 level course relative to what we talked about today.
Yes, I appreciate it, and I appreciate y'all's responses, and it just helps overall because we're getting questions from lenders in terms of what that bottom line value is, so they can understand how to provide a loan to our customers.
Jim, I was
Tell
going
them
to
to do
ask
the Freddie
you,
Mac training. Sorry.
and maybe just to clarify, it's because it's the same but maybe a different response. You're talking appraiser to get your homeowner a mortgage and not appraiser to get a construction loan.
That's correct. It's just the home buyer on the home buyer side. Yes, ma'am.
Okay. And I think that goes back to, I feel like Bill, you explained it pretty well. It's like there is value in that leasehold interest, the land itself. I mean, shorthand, we say in a foreclosure scenario, it would become a market rate ground lease and you would sell it on the market. So we tell appraisers, appraise it at market value, and there is some nuances for appraisers between fee simple and lease held land that, right, depending on appraiser and the mortgage lender you're working with. But um, there's a lot of value, and usually you're looking at the land and the property together and not typically trying to separate the land value from the property that's on it.
Yes, ma'am. And I appreciate the responses because it really is the lenders really trying to think creatively to figure out ways on how they can provide a loan and then not have to use the mortgage interest premium to reduce the cost of
Right.
overall getting into the home. Mhm.
Sometimes it's just introducing your lender to another lender. And I'm not volunteering Bill and Sarah, but I think I heard one of you say sometimes that's just what it takes, lender to lender.
Sounds good. We appreciate it. Thank you.
All right, we are just a little over the end of our time, but we really appreciate you all spending an hour and a half with us. And just again, so grateful to all of our panelists. This has been such a good discussion, and we did cover a lot of ground, hopefully planted some seeds for folks that are interested in these topics. And hopefully also we'll have more opportunities for deeper dives into each of these areas. So we will send the recording and send the slides out. There was a request also for some of the question responses. We could include those as well. And just appreciate you all. Again, thank you so much.
Thank you all.
Thanks, everyone.